marginally. And yet, at the same time, we can't cease to talk about FIIs. They remain net sellers for 31 sessions in a row, and they've sold shares worth 3,000 crore rupees today itself. So what's the direction of the markets now? Have we truly peaked? Let's find out. Sunil Subramaniam, market expert, joining us. It's always a pleasure having you on the show, Sunil. As soon as the markets start trending down, we mark the reasons. Yes, of course, there are concerns over high valuations and foreign outflows and the weak rupee, but to you, are we well and truly out of that Trump trade that we saw? Would you say foreign investors are now more or less convinced of higher returns from American equities and bonds rather than Asian and particularly Indian equities?
No, I'm not sure it's that easy. I think there are three reasons for the sell-off, right? So I think one of them is, of course, the fact that with Trump coming to power, US is a very attractive market because they don't have a currency risk when they invest in the US, right? And Trump's actions are going to be pro-US businesses. So they do expect tax cuts to come in, and they expect that Trump will impose tariffs on China and other countries. So US manufacturing should get a boost. So naturally, there's a Trump trade going on in the US stock market. The second is the fact that the debt market in the US is also predicting a higher interest rate. You see, the long end of the interest rate curve has started rising. So you get risk-free interest rates of 4% plus in the US. It makes it that much harder to consider an emerging market for investment. This is an overall net negative to emerging market kind of trend. The second aspect here is to look at the fact that India, the earnings season hasn't turned out as expected, right? You mentioned valuations. Even the prior earnings expectation, which were higher, India was looking expensive. And so whenever there was a positive China news, you saw money flowing out of India into China. But now this earnings season actually has confirmed that there is indeed the impact of two things. One, the lack of consumption pickup in the pre-festival period, plus the fact that the government spending for the first half has gone quiet on capex. So I think the combination of these factors has led the people revising down the FY25 and FY26 earnings. So naturally, India looks even more expensive from an FII perspective. But a third and equally important reason has to be taken into account, which is that as we end the close of the calendar year, hedge funds have to book cash profits in order to pay bonuses to their fund managers. So they have to book profits. Now, how much the recent correction is that even before the recent correction, the MSCI India index has delivered 27% returns for the year. So they will book profits in that market where they make the most money, and India is one of those. So naturally, that profit booking will now be going on. So it's all the three factors put together. So yes, you can't put it on any one.
No, but that one point that you made about how expensive our equities are in our part of the world, especially when you compare it to what's happening in the US and when you compare it with other emerging markets as well, how is India faring? Because the competition that we have for foreign flows, even if you consider American equities, they aren't cheap either. A stock like Nvidia is trading at a multiple of 65x.
Yes, but remember in the US, the rally has been a very concentrated rally. But now it is going to become more broad-based because US manufacturing is now going to get an allocation of equity capital. Whereas earlier, it was mostly the FANG, the tech stocks, the AI-related stocks like Nvidia. These are the ones which took the NASDAQ to very great highs. But if you see the S&P 500, there are lots of companies which are manufacturing companies which are now getting a boost. So in the US, there is a sector rotation happening away from those which rallied a lot to a lot others. So it's not just that, it's a matter of US versus India. The second aspect here is that from India's perspective, right, it's always been a case of a good long-term story for long-term capital. But short-term hedge funds are always looking for the best, price point from which he can make money. And so China became attractive sometime, like I said. So this is a Trump trade in the US that's happening. Now, soon when Trump's policies come out, he appoints his secretaries for various things. Yes. There will be clarity, it will cool down. And at that stage, I would expect that come January, we should see the return of the FII to India because this money which they are booking profits will need to be redeployed. Second, the Diwali season has gone well for certain sectors. So the October, November, December quarter earnings in January when they come out, I expect the market to revise the earnings upwards. The valuations will look much more healthier because there has been a correction and there'll be an earnings upgrade. And then in February 1st, you have the Indian budget. So the hype and the hoopla around the capex spend, and government also, remember, the government hasn't spent in the first half. So
Yes.
they have to up the spending, otherwise that money lapses. So I expect the government also to have stepped up its capex spending this quarter. So next quarter's earnings I expect to be better, and hence, slight division and upgrade, the valuations look much healthier from a return of the FII. So I expect the return of the prodigal son, if you may say, so to speak, in January, and so it should come
But
back.
meanwhile, do you agree with the perception that any stock on the Nifty today that is worth buying is either fully priced or trading way above its 2-year average even? Because that suggests that our markets have peaked, at least for the moment. We'll have to wait for January. But meanwhile, this correction, how deep do you think it could run? That's the next obvious question, isn't it?
So the correction can't run very much deeper because you just saw the mutual fund inflows come in today, right? So you had a record SIP book of 25,000 crores. You had a record 40,000 crores in pure equity. There's another 9,000 crores just come into hybrids. And you have the passives, which also have raised 10,000 crores this month. So domestic fund managers are sitting on 60 to 70,000 crores of money raised last month, which will act as an effective buyer to protect a fall. In fact, I would say the FIs will be disappointed because when they sell off, they expect a deeper correction that makes it easy for re-entry. But the Indian domestic investors are not allowing this. These flows have come in because mutual fund distributors and investors have seen the correction as a buying opportunity. So I think strong domestic support for the stock markets will ensure that the falls will not be very severe. There will be volatility, there will be falls, and there will be why those falls will be there. Because fund managers, when they got cash on hand, it's not that they buy the stocks immediately after they fall. They wait for them to fall further so that they can maximize their profits. So there will be some amount of volatility because domestic fund managers wait for stocks to correct and then they come in and step in and buy.
So,
So I expect increased volatility,
right.
but not necessarily a deep correction.
Right. So volatility is something that we should brace for. But when you talk about profit booking, which are the sectors where that is likely to happen the most? Is it going to be PSU stocks after the run-up they've had? We've seen financial stocks today, particularly HDFC Bank, SBI. They've led the big declines, and that has pushed the Bank Nifty to one of its sharpest drops in over a month. How do you expect the financials to do? Is there going to be a lot of profit booking there, do you think?
I don't think so, because if you see the last 1 year, the Nifty return was about 27% before the current fall, and the Bank Nifty had delivered only 20%. So the Bank Nifty hasn't been the one which has driven the Nifty up. So you mentioned the PSUs. I think energy sector is one. The metals is going to obviously going through, because China's growth is not coming back, so metals are under pressure. So I expect those where the valuations rose up sharply, and financials are not among those. Right, there's where the correction. So definitely some PSUs, definitely energy, some amount of metals, and maybe some related infra related like defense. Right, all of those which ran up a lot. That's where the profit booking will dominate.
Driven stocks, Sunil. They're likely to take some of the biggest knocks, at least from some quarters, is what we are picking up. Q2 earnings have been rather weak. You mentioned it yourself. And look at today's trade. The FMCG pack got those declines for a second session on the trot. And if you look at stocks like Britannia, Godrej Consumer, they've led losses. Pointing at slower demand, they are talking about pressure on margins with higher input costs. And those could persist because we're talking about certain weaknesses in demand at this stage, and those could last, don't you think?
You see, I see the negative surprise has been the urban demand cooling off.
Yes.
Right. So rural demand, good monsoon. I think it will hold up. You'll probably see this quarter's earnings come and show rural demand holding up. But urban demand definitely has cooled off unexpectedly, and I think that's why these FMCG pack stocks are showing the correction. But I would still say that in Jan, when FIS come back, FMCG will be among the top picks because they are more safer, because they are not so cyclical and sharper. So I think that the correction in the consumption and the FMCG consumption is going to be fairly short-lived. It won't be sharp drops going forward. I would actually say that buy on dips will be a good strategy around the consumption pack, because I think that in the coming months, in the new year, you will see consumption actually pick up strongly. I think that's my read of the markets. So I'm not sure that consumption is something that you should be selling a lot of. And buy on dips should be the better strategy there.
Sunil, so in passing, I want to ask you where you're seeing the Nifty at the end of this calendar year.
Well, some weeks back, and I gave a prediction that's way off. So, see, from a volatility perspective, I think 23,000 is a level around which I would think the Nifty should hold.
Right.
So 22,500 to 23,000. I don't think it will go below that because I'm sure domestic fund managers will sense a big buying opportunity if it corrects that much. So I think that's the kind of support level I see for the Nifty in the year by the year.
Indeed. Well, we'll be monitoring that space very closely and we'll keep circling back to you. But right now, of course, there is a lot of concern whether America is going to go ahead and raise those tariffs under President-elect Donald Trump. And if he does, is it going to slow global growth? Because on that depends how countries and emerging markets like India does. We'll have to wait and watch those kind of moves. But for the moment, we'll leave it at that with the reassurance coming in from Sunil Subramaniam that we're likely to see all that change by January. This volatility is here till the end of the year at least. We'll keep marking that. Thanks very much for joining us on the show, Sunil Subramaniam.
Thank you.
Meanwhile, consumer prices have surged higher